Alright everyone, welcome back. Today, we're diving deep into the USD liquidity situation. The title says it all, darkness before dawn? We've got some conflicting signals in the market right now, and I'm going to break down what it all means for your portfolio. Let's get started. So, here's the core contradiction I'm seeing today. On one hand, fear is hitting extreme levels, and we're seeing classic short squeeze signals. But on the other hand, liquidity is draining fast, and institutions are selling again. It's like two different stories are playing out at the same time. Why the disconnect? Let's dig into the data. If I had to sum up today's market in one sentence, it would be this: we have a technical setup for a bounce, screaming by the dip, but the fundamental liquidity picture is flashing warning signs. It's a classic battle between short-term technicals and long-term fundamentals. Is it truly darkness before the dawn? Let's check the key data to find out. Let's start with the big picture. The DXY is holding above 100, which is a key level. But look at the liquidity numbers. ON RRP is collapsing, bank reserves are below a critical threshold, and the Treasury is draining cash. This is the engine of the market, and it's sputtering. I'll break down what each of these means next. Now let's look at the assets themselves. Gold and oil are both sitting at the lower end of their recent ranges. Bitcoin and Ethereum are slightly down on the day, holding above key support levels for now. The lack of strong movement here, despite the fear, is interesting. It suggests a market that's unsure which way to go. Here's where things get really interesting. Crypto sentiment is at an extreme fear level of 13, which is a classic contrarian buy signal. Funding rates are negative, meaning shorts are paying longs, another bullish sign. But, and it's a big but, BTC ETF saw outflows again. So retail is scared, but institutions are selling. Who's right? Let's look at the liquidity conditions. I want you to focus on these two numbers. The ON RRP is the liquidity buffer the Fed provides. It's dropping like a rock, down $361 billion in just a few days. At the same time, bank reserves are stuck below a critical $3 trillion level. This is the lifeblood of the financial system, and it's being drained. This is not a healthy sign. This slide assesses the current liquidity conditions, focusing on the TGA and the broader systemic picture. 1. TGA account. The Treasury General account stands at $10.06 trillion. Fiscal operations are actively draining liquidity from the market, which means less capital is available for banks and financial markets. 2. Key observation. The most critical point is that the ON RRP facility is draining fast, and the overall liquidity buffer is tightening significantly. 3. Implications. The combination of low bank reserves and the Treasury pulling more cash out of the system creates a tighter liquidity environment. This setup typically leads to higher market volatility as there is less capital to absorb shocks. Alright, let's distill all this down into three key signals I'm watching right now. The strongest signal is the extreme fear combined with a short squeeze setup. The secondary signal is the collapsing liquidity. And the third signal is the return of institutional selling. Let's break down each one and what it means. This is the most compelling signal for me. We have extreme fear, which is a classic bottom indicator. And we have negative funding rates, which means short sellers are getting squeezed. Historically, this combination is very bullish. But, and it's a crucial but, we need to see the price actually stop falling to confirm it. So, is now the time to buy? This is the dark cloud hanging over the market. The ON RRP is falling fast. Think of it as the spare gas in the tank. We're burning through it quickly. If we get close to empty, below $100 billion, we could see a real liquidity crisis. This is the biggest risk factor I'm monitoring right now. And here's the third piece of the puzzle. After one day of inflows, the big money is selling again. This tells me that the smart money isn't convinced the bottom is in yet. They're still reducing their exposure. This selling pressure is a headwind for any rally. So, who do we trust, the technical signals or the institutional flow? So, putting all this together, I see three possible scenarios. The most likely one, at about 55%, is that we're forming a bottom here. A technical rebound is also possible. But we can't ignore the 15% chance of a full-blown liquidity shock. I'll walk you through what each scenario means for your trades. This is the scenario I'm personally leaning towards. If Bitcoin can hold this $60,000 level and the short squeeze pressure continues, we could see a slow and steady climb back up. It won't be a V-shaped recovery, but a grind higher. This is the most optimistic path, and it's the one with the highest probability. This is the buy the fear scenario. If the selling from institutions dries up, we could see a sharp, fast rally as all the short sellers rush to cover their positions. This would be a great trading opportunity for those who can time it right, but it could also be a trap if the fundamentals don't support it. This is the scenario we all need to be prepared for. If the liquidity drain accelerates and the dollar keeps strengthening, we could see a repeat of past crises. All risk assets, including crypto and stocks, would get hit hard. This is a low probability event, but the consequences are severe, so we can't ignore it. This is the anomaly I keep coming back to. The fear gauge is screaming buy, but the smart money is still hitting sell. This kind of divergence doesn't last forever. Eventually, one side will be proven right. I'm watching this battle closely to see which way the market breaks. So, let's wrap it all up. We have a battle between bullish technicals and bearish fundamentals. The most likely path is that we're forming a bottom, but we need confirmation. I'm waiting for three key things before getting more aggressive: the price to stabilize, ETF outflows to slow, and the dollar to pull back. These are the three things I'll be watching like a hawk in the coming days. The fear index tells us how much pain is in the market. The ON RRP tells us the health of the financial system. And the ETF flows tell us what the big money is doing. These three indicators will give us the answer.